China's real estate sector has been one of the main drivers of its economic growth for decades, but it is also one of its biggest vulnerabilities. In recent months, the signs of a looming crisis have become more evident, as some of the largest property developers have defaulted on their debts, triggering panic among investors, homeowners, and regulators. Today we will explore the causes and consequences of China's housing market crash, and how it could affect the global economy and geopolitics. China's property boom can be traced back to the late 1970s, when the country began to open up its economy and implement market reforms. As millions of people moved from rural areas to urban centers, the demand for housing soared, creating a lucrative opportunity for developers and speculators. The government also encouraged real estate investment as a way to stimulate growth, create jobs, and improve living standards. However, this also led to a massive oversupply of housing as developers built more and more apartments, villas, and skyscrapers, often with little regard for quality, safety, or environmental impact. Many of these properties remained vacant or unsold, creating ghost cities and ghost towns across the country. According to some estimates, China has enough housing to accommodate 3.4 billion people, more than twice its population. At the same time, the prices of housing kept rising, fueled by cheap credit, lax regulation, and speculative demand. Many Chinese people saw real estate as the best way to preserve and increase their wealth, as other investment options were limited or risky. As a result, China's household debt rose from 18% of GDP in 2008 to 62% in 2020, while the average price-to-income ratio in major cities reached 23.6 in 2019, compared to 9.4 in the U.S. The combination of high debt, high prices, and low occupancy created a fragile and unsustainable situation, which was bound to collapse sooner or later. The trigger for the collapse came in September 2021, when Evergrande, China's second-largest property developer, announced that it was unable to pay its debts, which amounted to more than $300 billion. Evergrande had been borrowing heavily to finance its aggressive expansion, but its cash flow was insufficient to cover its interest payments and obligations to suppliers, contractors, and customers. The news of Evergrande's default sent shockwaves through the financial markets, as investors feared that it could trigger a chain reaction of defaults and bankruptcies among other developers, lenders, and related industries. The stock prices of Chinese property companies plunged, while the yields of their bonds spiked, indicating a higher risk of default. The contagion also spread to the global markets as foreign investors and creditors scrambled to assess their exposure and reduce their losses. The crisis also sparked social unrest, as thousands of Evergrande's customers, who had paid deposits for unfinished homes, staged protests and demanded refunds. Many of them had invested their life savings or borrowed money from relatives and friends to buy their dream homes, only to find out that they might never get them. Some of them even threatened to commit suicide or harm Evergrande's executives if they did not get their money back. The government, which had been trying to rein in the property sector for years, faced a dilemma: whether to bail out Evergrande and other troubled developers, or to let them fail and face the consequences. On the one hand, a bailout could prevent a systemic collapse and social instability, but it could also create moral hazard and encourage more reckless behavior in the future. On the other hand, a failure could cause a severe contraction and contagion, but it could also force a painful but necessary adjustment and deleveraging. China's housing market crash is likely to have a profound and far-reaching impact, not only on China but also on the world economy. The real estate sector in China accounts for about 25% of its GDP, directly and indirectly, and employs about 80 million people. A sharp decline in construction, sales, and investment could drag down the country's overall growth and consumption, as well as the demand for raw materials, energy, and goods. This could also affect the global economy, as China is the world's second-largest economy and the largest trading partner for many countries. Moreover, the property sector in China is deeply intertwined with its financial system, as it represents about 40% of the total bank loans and 70% of the household wealth. If a wave of defaults and losses occurs, it could impair the balance sheets and liquidity of banks, shadow banks, and other financial institutions, and erode the confidence and trust in the system. This could also trigger capital flight and currency depreciation, making it more difficult for China to repay its debts and increasing the risk of a financial crisis. Apart from the economic and financial consequences, a housing market crash could also lead to social unrest in China. The property sector has been a source of social discontent and inequality, as it has widened the gap between the rich and the poor, the urban and the rural, and the young and the old. Many Chinese people feel frustrated and angry about the high cost and low quality of housing, as well as the lack of affordable and accessible alternatives. A collapse of the housing market could exacerbate these grievances and spark more protests and violence, especially among the middle class and the millennials, who have high expectations and aspirations. Furthermore, the property sector in China is a challenge to the political leadership and legitimacy of the Communist Party. The party has based its rule on delivering economic growth and social stability, and a housing market crash could undermine the party's credibility and authority. It could also expose its corruption and incompetence, fuel dissent and opposition, and test the party's ability and willingness to reform and adapt to changing circumstances. In conclusion, the impact of China's housing market crash could be profound and far-reaching, affecting not only the Chinese economy and society, but also the global economy and political landscape. The consequences could range from economic slowdown and financial instability to social unrest and political challenges, creating a complex and uncertain environment for China and the world. China's housing market crash is a serious and complex problem that has no easy or quick solution. It will require a coordinated and comprehensive response from the government, the market, and society, and a balance between short-term stability and long-term sustainability. It will also entail some trade-offs and costs, which will have to be shared and borne by all the stakeholders. Amidst the ongoing crisis, China has a chance to tackle the deep-rooted structural and systemic issues that have hindered its economy and society for years. By doing so, China can make a shift towards a more balanced and inclusive model of development. To achieve this goal, China can take various steps and measures. One of the significant measures is to strengthen the regulation and supervision of the property sector, along with cracking down on the malpractices and irregularities that have contributed to the bubble and the bust. This can be done by imposing stricter rules and standards on lending, borrowing, building and selling, enhancing transparency, and ensuring accountability of the developers, lenders, and regulators. Another crucial step is to reduce and restructure China's debt and leverage in the property sector and resolve the insolvency and liquidity problems of distressed developers and lenders. This involves implementing a market-based and orderly process of debt restructuring, asset disposal, and equity injection, and providing targeted and conditional support and relief to the affected parties. China can also diversify and innovate its sources and modes of financing and investment in the property sector, while reducing its reliance on bank loans and pre-sales. This can be done by developing and expanding the role and scope of the capital markets, such as the bond market, the stock market, and the REITs market, and promoting and facilitating the participation and competition of the private and foreign players. And that's it for this video. We hope you enjoyed watching it and learned something new. If you did, please give this video a thumbs up and share it with your friends. Also, don't forget to subscribe to our channel and hit the bell icon to get notified of our future videos. We have more amazing videos coming up, so stay tuned. Thank you for watching, and see you next time.